Good morning, it's today again. Welcome back to Joseph's Reserves. I'm Joseph, and I store 20% of my income in the form of rare coins and precious metals. Today, we're going to be taking a deep dive into the precious metals and industrial metals that I've been watching recently: gold, silver, platinum, palladium, and copper. We're going to be diving deeper than just the prices. We're going to look at the percentage change, the trends, and what the ratios reveal about where some opportunities lie. By the end of this video, you'll understand what these metals are signaling about risk, industrial demand, and portfolio opportunities. And yes, we'll be analyzing the gold to silver ratio, the gold to platinum ratio, the platinum to silver ratio, and the platinum to palladium ratio. These ratios often tell a story that raw prices alone don't. Congratulations to Maestro's Metals for being the first to comment on my video yesterday. Y'all go find him down in the comments below to start a conversation. Before I get into this video, I want to remind everyone I am not a financial advisor and this is not financial advice. Always do your own research and manage your own risk responsibly. But we will go ahead and start to take a look at the weekly closes. So gold closed at $4,495 with an upward movement of 0.06%. Silver closed at $69.87 this week with an upward move of 2.84%. Platinum closed at $1,873 with a downward move of 3.15%. Palladium closed at $1,403 with a downward move of 2.03%, and copper closed with $5.48.68 for an upward move of 1.56%. So first, let's go ahead and zoom in on gold. We're seeing a minor movement of 0.06% change from last week. And over the last 3 months, it's been a mix of sideways moves with occasional spikes and dips that have largely supported the hold of around $4,300 to $4,500. Gold is the classic safe haven metal. Even small moves tell us something. Sideways action indicates that risk off capital is steady but not panicking. Investors are holding their positions, balancing between fear and patience. Gold also sets its baseline for several key ratios. This week, the gold to silver ratio actually went down by about 2 points as silver outperformed. Currently, the gold to silver ratio is 64.3, meaning it takes 64.3 ounces of silver to have the same value as 1 ounce of gold if we're just looking at spot value. This ratio is starting to drop or tighten as silver rises, hinting at a potential silver outperformance if the trend continues. Overall, the outlook on gold is steady, relatively neutral, and a reliable anchor in volatile markets as a key reference point for analyzing other metals. Now, if we take a look at silver, silver closed at $69.87, so it's up 2.84% this week. Compare that to 3 months ago, it's been a roller coaster, hitting highs of 119 and near lows of 67, even with an intraday movement down to about $60. Silver is unique. It is both a monetary metal and an industrial metal. This dual nature means that it reacts to fear and industrial demand. Its weekly performance relative to gold gives us the sense of the market sentiment. With the gold to silver ratio dropping, as I had mentioned, it's showing that silver is starting to catch up to gold slightly. Historically, when silver rises faster than gold, it often signals an optimism in the industrial sectors like solar panels, electronics, and medical tech. So silver's outlook short term is bullish if industrial demand persists, especially the gold to silver ratio continues to tighten. There may be a bit more of an upside potential here in silver. And platinum is where things get really interesting. It closed at $1,873 and is actually down this week by 3.15%, but over the last 3 months it's been highly volatile. peaking at 2,734 and dropping all the way down to what it is now. Platinum's main driver is industrial demand, particularly automotive catalysts, hydrogen fuel cells, and other high-tech applications. Its weekly drop suggests pressure in industrial sectors, but also creates potential opportunities because platinum is historically undervalued relative to gold. So let's talk about these ratios. The gold to platinum ratio is currently 2.4. Historically, it's been closer to 1.2 to 1.5, which indicates platinum is significantly undervalued versus gold. If you look at the platinum to silver ratio, it's currently 26.81. That is lower than its long-term average, showing that platinum has lagged behind silver. So while platinum is down, the ratio suggests some potential for trade and possibly even some catch-up coming in soon. If industrial demand picks up, platinum could see a sharp upside in relative to both gold and silver. If we shift our focus over to palladium, we see that it closed at $1,403, down 2.03%. So it's similar to platinum, and that actually makes a lot of sense. Platinum and palladium usually move very, very similar. Right now, the platinum to palladium ratio is 1.33, meaning that platinum is slightly cheaper than palladium. And historically, platinum and palladium almost kind of trade places and play somewhat of a jump rope over this 1-to-1 ratio. And what that means is that palladium does have a chance to catch up here. As industrial demand shifts between platinum and palladium, palladium actually does have a chance to outperform or simply catch up to platinum here. Most likely what we can see if platinum starts to perform very well, we'll see an expansion of this platinum to palladium ratio and then a sharp turn in palladium to catch up to platinum. So now we're going to talk about copper. Copper closed at $5.4868, which is actually up 1.56% this week. Unlike the precious metals, copper is mostly driven by industrial demand. Its rise tells us that investors are expecting continued growth in industries like electric vehicles, renewable energy infrastructure, and general manufacturing. Copper is the bellwether metal. It signals the health of the industrial economy. So while gold, silver, platinum, and palladium give us clues about market sentiment and relative value, copper tells us what the economy might be actually doing. So to put all of this together, gold is steady. It's being an anchor. It's holding risk off capital. Silver is slowly climbing, it's catching up to gold. Remember though, it has that dual purpose, so this metal is signaling both the monetary metals and a little bit of optimism in industrial markets. Platinum is down, however, it's undervalued relative to both gold and silver, potentially showing an opportunity for a trade. And palladium, also slightly down, it's mirroring platinum. The both of these moving downward together is showing a little bit of an industrial slowdown. However, copper is signaling a long-term industrial growth, specifically when it comes to economic growth. Then as we take a look at the ratios, it might tell a bigger story. The gold to silver ratio is tightening, platinum undervalued versus gold and silver, and the platinum to palladium ratio is slowly reaching upward. When you watch these ratios in addition to price action, you get insight into relative strength, under evaluation, and potential trade opportunities. So what does this mean for us as stackers? Let's dive into some practical takeaways, especially for those new to the metals market. First, it's important to understand that each metal plays a distinct role. Gold tends to be more stable. It acts like a financial anchor. When fear rises, gold holds steady. Silver, on the other hand, is more volatile. It surges when optimism builds and drops quickly when it fades. Platinum and palladium, they're even more tied to the industrial demand. When auto production slows or EV investment dips, those prices can drop. And then there's copper. Copper is the heartbeat of industrial growth. When it climbs, it's often a signal to investors that are betting on future expansions in EVs, data centers, or renewable energy. What's very important here is instead of picking just one metal and hoping for the best, all of us should be building a full portfolio and balancing it with ratios, our own personal gold to silver ratio, our own personal platinum to palladium holdings, and things like that. We want to be looking at how these are moving against each other, but specifically in the value that we hold them in. I suggest looking at your metals portfolio as a whole in terms of value and determining how much of each of these metals take up that value by a percentage. Looking at it this way, you can see how much you've invested into either gold, silver, platinum, palladium, or copper. And once you have that number, that specific percentage, you could see where maybe if you're heavy in platinum or palladium, you might be heavy in silver. That might put you in a risk situation in which you're a little bit more invested into one more volatile metal than you actually realized. Or you might be frustrated that your portfolio isn't growing quick enough because you have too much of it in gold. While gold is a very stable asset, it does move up slower than oftentimes a lot of these silver, platinum, and palladium metals. So having set ratios or percentages of your portfolio in terms of value helps you understand how much of a bet you've made on a specific metal and helps you realize how and when to make trades and in what direction. Let's say you had a specific ratio and silver ran up way faster than gold. Not only will that be evident in the gold to silver ratio, but when you are tracking your own percentages, you'll see that your silver holdings in terms of value has gone up exponentially while your gold might have gone up, but the overall percentages looks like gold has gone down. In that specific case, you could say that it could be smart to trade some of that silver back into gold. That way you're managing the percentage how you have already previously defined it, and at the same time you're trading a metal that has just had a massive run up into one that is most likely lagging behind and will shoot up shortly after. Using this ideology, I was able to trade 1 ounce of gold in April of 2025 into silver, and then use that same silver to actually trade back into 2 ounces of gold in January of 2026. I wasn't able to time these perfectly with the gold to silver ratio movements. However, just using this idea of a percentage basis, I was able to time it very well. And using a system like this isn't about timing it perfectly. I personally dollar cost average into silver, so these ratios are going to change over time. However, because I'm not constantly looking at times to do it, I'm just looking at my actual holdings, I'm going to be slowly transitioning when it makes sense for my stack, not just market signals. In short, don't just focus on one metal. Watch these ratios and how the metals perform against each other. When gold stays steady, silver and platinum might give you the next big move. By doing this, you don't just react, you stay proactive. You're balancing fear and opportunity and industrial optimism, all in one portfolio. I just made my own line of coffee. Joseph's Reserves It's Today Again coffee. Most mornings aren't dramatic. They're quiet. You wake up, pour yourself a cup, and now you have a choice. Drift through the day or take hold of what's in front of you. That's really what this whole thing's about. Showing up, building good habits, staying disciplined in the small things. Whether that's stacking consistently, learning something new, or just being faithful with what you've been given. I put these words on every bag to remind myself first. Every morning is a gift. Not yesterday, not tomorrow, today. So take a breath, take a sip, and let's get to work. It's today again. You can now write me at Joseph's Reserves, 10160 Highway 242, Suite 800, number 401 in Conroe, Texas, zip code 77385. Make sure to include your information so I can write you back. If you like today's video, make sure to go down and give it a thumbs up. Go into the comment sections for any questions or comments. Share the video to anyone you think may like it, and subscribe if you haven't already. But most of all, thank you so much for watching. And just remember, every ounce adds up. So no matter how small, just keep stacking.